Welcome, everyone. Go ahead, Mike.
I was just saying, good afternoon, everybody. Thanks for joining us. We're going to start the program in a little bit. Michael's going to kick us off, but we're going to wait for a few more people to join, and then we'll get going.
Well, welcome, everyone. It is 1 o'clock, and so I'll kick us off here. My name is Michael Urch. I am a CFP professional and senior wealth manager here at 360 Financial. We also have Mike Rogers, our president and founder, on, as well as Brian Vonzek, a senior vice president. And the three of us are members of our investment committee, which has 8 members altogether. And we're here to bring to you all some of our thoughts on an outlook for 2025 and some of the latest from the investment committee. And so in this session, we're going to look back at 2024, reflecting on some of the major themes that define the markets and look ahead at 2025. We'll look at some key economic trends, market dynamics, and strategies to help navigate the year with confidence. And here at 360 Financial, we exist to enrich lives. And one of the significant ways that we go about doing that is by helping manage investments for our clients. And so today we're going to be talking through some of the thinking that we put behind that. So without further ado, I'll hand it over to you, Mike, to kick us off.
Oh, thank you, Michael. And looking forward to this program and putting out this information that we think is going to be timely, and it's going to also be relevant based on what's going on in the world and the economy here in the U.S. And we had a terrific year last year. If you went back and maybe reviewed our webinar from last year, we were looking for a few things that did occur. And one area that we were looking at last year was inflation was still pretty high at this time last year. That has subdued. We'll talk today more about inflation. Interest rates were pretty high. Those were coming down, we predicted. Thought the stock market was going to have a good year. Not nearly as good as it actually turned out to be. And a lot of that was driven by earnings. And we talked about that last year as well. If earnings surprised to the upside, that would be good for the stocks. We definitely saw that from some of the technology areas. So, just a few things to cover today. We're going to talk today about what's going on in the economy, of course. That's always one area. We have a new administration coming in, so we're going to talk about that. We'll talk about the stock market, the bond market, and to a certain extent, commodities, because they're affected by inflation and interest rates. And so that's kind of the general outline of today's program. What we're not going to talk about are the Vikings. So we're going to move on from that, as Brian shakes his head. So there's a lot of you know on the program here that Brian manages our Elk River office. He joined us a couple of years ago, and through a merger of his firm and our firm. So he's up there in the Elk River office. I'll also talk a little bit about our CPA offerings. We have a CPA office over in Edina, and some people here who have joined us today are our clients of the CPA firm, and we also have some people from the CPA firm on the call as well, but not as part of the panelists. So that's an overview of what we're going to cover today. I'm going to open up the presentation. We'll do some screen sharing, so all of our pictures will get small, and I will kick off the Outlook 2025. And we've got it titled here, Pragmatic Optimism. So there's a lot going on and that we want to talk about, and just kind of put in perspective how good last year was, and frankly, the year before, bouncing out of that 2022 market that was very, very difficult, negative stock market, negative bond markets, and nice rebounds in 23 and 24. So we'll go into that. And the one thing that we're doing to make this a little bit more interactive is a poll. And so on your screen should show up some activity around a poll and the economic outlook, and what do you think is going to happen? There's a few different areas. We have very optimistic, somewhat optimistic, neutral, pessimistic, and very pessimistic. So that'd be interesting to see what some of our viewers think about the economic outcomes. We'll wait for a little bit for some of these to pop in and populate. Michael and Brian, can you see these poll data?
Yes, okay. I can.
So very interesting. Out of the polls that we have, the poll numbers we've received so far from participants, Nobody is very optimistic. We have somewhat optimistic, neutral, and somewhat positive, pessimistic. Nobody's very pessimistic. Nobody's very optimistic. We're kind of in the middle there. And you know what? That's probably a good spot to be. I think it bodes well for the theme of pragmatic optimism. So with that in mind, I'm going to jump into the consumer aspect of the economy and just talk a little bit. And this is where Brian and Michael will also jump in, of course, as well. We're going to make this conversational for you, so it's really interesting. And so when we talk about consumer spending and we talk about kind of what's going on in the world, this is one part of the chart that I think is very interesting. It's business spending, and we'll talk a little bit more in detail about this. But what this chart is showing you is that capital expenditures, or CapEx, as it's called, had gone up quite a bit between 20 and 23, 24 time period, but business owners said they were waiting mostly for the elections to get over before they decided what they might be doing from a spending perspective for this 25 time period that we're in now. So if we can get some good CapEx spending from businesses, that should be something that would be very good for the economy and for the markets in general.
Now, with the CapEx spending, one of the questions that we ask as a committee is there any particular area where companies are planning to invest more than they have in the past? And we were looking at some data recently around a group of companies that are referred to as AI hyperscalers. They're the companies that are putting in data centers to be able to operate AI. And if we just look at historical data from 2022, they invested about 126 billion in data centers. Estimated for 2025 is about double that. And so we're seeing some significant capital expenditures in that area. I think that opens up some opportunities for us to look at electric grid or other infrastructure-based investments. And that's one of the conversations we're regularly having.
Yeah, you know, you're absolutely right. I mean, if you look at what's going on especially in the world, as far as this whole AI development and the spending that's going to go on there, it's pretty phenomenal numbers. It's you had come up with, Michael, from the research that you were doing in this area. So that plays well into exactly what we're talking about, this demand for CapEx growth. We also think consumer spending should be relatively robust as well. And so, Brian, you've got some thoughts on this slide specifically around the millennial spending.
Yeah, I thought this was interesting. Obviously, business is a big part of our economy, but even the bigger part of our economy is the consumers, and low unemployment that we've had over the last several years, a couple of years, that's been helping our economy drive that. But the other thing that's happening is the high wage earners, the millennial group, is going to continue to get into their peak earning years over the next 5 years, and that's going to drive more consumer spending as they make more money. And we talked also in our investment community about this wealth transfer that's happening out of the baby boomers. The baby boomers the youngest baby boomers turn 60 this year, and they all go older from that. And so obviously we know that what happens is they start transferring wealth, as they get older and they pass away, and that's going to fall into that same generation that's peaking in their earnings. So a lot of good tailwind coming into the next 5 years. So I think that's what this graph is really kind of showing, that those 40-plus-year-olds, 35 to 54-year-olds are going to continue to drive our consumer spending. And that's, again, a positive, because we know those people go out and spend money, and those are earnings that will show up in corporations, So.
Absolutely. And they're out spending money on all kinds of different items. I mean, it could be, they're in those kid years too. So you're either buying diapers for those young kids. We've talked about that, and Michael has some recent experience with that.
Yes, I do. Lots of diaper expenses in the Urch household.
Yeah, but the fourth child is coming, but they're also buying cars. They're buying bigger cars. They're buying clothes for the kids. There's a lot of spending going on in that area around a number of different areas. So it's between this and the CapEx spending, we think the economy is going to be pretty decent, just because of the fact that there's going to be both elements of spending going on, probably in the short run, and we anticipate longer term as well. So the other thing that's interesting too is when you look at spending, where does it come from? And higher income households are the ones that are really driving the consumer spending. And this chart is kind of illustrating it, basically looking at household income broken down into different quartiles. And so you can see the top 20% household spending down at the bottom is where we get our biggest spend amount, and the vast majority of the spending occurs kind of in these two lower bars. And these higher income households aren't really impacted by a couple of things that we've seen been going on recently. That's increased rents because they're not typically renting, and they're less impacted by the pandemic induced, issues that we've been having the last couple of years, especially when it comes to inflation. And they might, in turn, be less impacted by any tariffs that could be coming or the ones that have been in place. Remember, the last time Trump administration was in office, they instigated tariffs, and most of those tariffs did stay in place during the Biden administration. So we've been having tariffs now for about 4 years, and the higher income households again can kind of get by without being too impacted by those tariff costs. Okay. So the key point is let's just keep watching kind of what the upper income consumers are doing, where they're shopping, how they're managing their expenses, and this might be kind of a leading indicator a little bit on the economy as we move forward into 2024 and into 2025 and into 2026. So, the other thing that's come up frequently is inflation. We talked about this last year quite a bit, and the reason is last year at this time we had higher inflation. We predicted and expected that inflation was going to start coming down. The Federal Reserve wants to see 2% inflation as kind of their goal. We're not there yet. One reason we're having a little bit of a sell-off in the stock market into this new year is because there's concern that we're not trending towards that. The PPI numbers just came out this morning. Those are the wholesale numbers, and they actually looked pretty good as far as moving again towards a lower inflation rate. But inflation is definitely decelerating. It has, I should say. And we think getting down closer to the 2% number is something that's pretty realistic sometime maybe in the second half or end of this year, depending on what the economy does. And if we're correct about the economy growing at a decent rate, maybe last year was about 3%, even if it grows at 2 to 2.5%, that gives us room for inflation to come down a little bit further. From the other thing that's happened a little bit that's kept our rates up is that we all know this, insurance rates have gone up quite a bit. That's part of the inflation calculation. And these natural disasters and these that we've been experiencing throughout the country, and these fires that are going on currently in LA, and our thoughts and prayers go out to all the people out there, of course. But those are insurance issues that come up for the insurance companies. And typically the reason we're seeing such high increase premium amounts on our auto insurance policies, our homeowners insurance policies, is to cover a lot of these events that have been occurring the last couple of years. And rents, as I mentioned earlier, haven't really been going down. They've been going up. And both of those have kind of created an environment where inflation's been struggling to get down into those 2% levels.
With inflation being a little bit stickier, the Fed is likely to do more of a cut and pause cadence as they're looking at decreasing rates this year. And so we're thinking maybe 2 or 3 cuts at this point, but it's something where we want to watch and see what happens with inflation, what happens with unemployment, and keep eyes on that throughout the year.
Yeah, absolutely. We were thinking that, even as recent as a month ago, maybe 4 rate cuts were going to come, and so was most of the market. Brian will talk a little bit about that on the bond part of the presentation. But you're absolutely right. If we're not going to get to a point where the inflation numbers are as low as they want, we're expecting less cuts this year than maybe was thought of even a month ago. Okay. All right, so we're going to do another poll. And this one's on the stock market predictions. And what are your expectations for stock market returns for this coming year? Or this year. We're 2 weeks into it now. So the polls popped up on your screens. I think stock prices will go up. I expect little change. They'll stay about the same. I think there could be some downturns, but it will recover. And I see a significant decreasing in stock prices. So we'll let some of the poll numbers come in and see how the participants, you guys watching, are thinking, and we'll see if it corresponds a little bit to what we're thinking. All right, so we've got some good data points in here. I think stock prices will go up. It's about 27% of the polls, so 1 out of 4. I expect little change. Was only 9% of the respondents. And then I think that there could be some downturns, but it will recover is 64%. So what that's telling me is most of you on this presentation today are expecting more volatility than what we've had in the past. And so we would probably concur with that. And that's again why we have this pragmatic optimism about the market. So we'll jump right into that piece. So our measured approach in 2025 is this really on the heels of 2 outstanding years coming out of when the bear market ended in 2022, gives us some data points. So the bull market that we entered in October of 22, see if I can, on this slide, it's right down there at the bottom. That's when the 22 market stopped decreasing, basically. That was a tough market, as you all remember. And so year 1 out of that, so October to October of 23, markets were up about 21%. And this is the S&P 500 index. And then the year 2, a whopping 32%. Now, we didn't end the calendar year at 32%, just the way that the rolling time periods here work. But the S&P 500 is up nearly 70% since this move began, with a booming year in 24 here, most of 24, which followed, a very respectable 21% return. So a very good year. And what we're showing here is, as the results of a surprising resilient economy, moderating inflation like we talked about, good earnings coming out of especially the tech sector, were part of the reasons that we saw such a rebound in stock prices over the last couple of years. And history would tell us, though, as I'm looking at some of my data points, history would tell us that this is a scenario that we're not necessarily going to see repeated for a 3rd year. We will take it, as I always tell people. But if you look over on the right-hand side of this bar chart, it shows year 3, and it shows the rate of returns. When we make it through 3 years of a bull market, the average rate of return during that time period is only about 5%. Okay, so the X's on this represent when we didn't make it through a bull market, and that's predominantly because we went into a recession. Okay, we don't think of recessions on the immediate horizon, with interest rates kind of where they're at and unemployment actually dropping from 4.2 to 4.1%. Economy, it looks like it's doing pretty well. So if we are more pragmatic in our approach, and again, so hard to predict what the stock market returns are going to be, but we would expect kind of like what the poll is expecting that we just talked about. We'll have some up and downs. Stock market generally goes down anywhere from 5 to 10% every single year. So we think that will occur again this year. And maybe we get into this 5 to 7% sort of rate of returns that you could visualize out of the S&P 500. Brian, Michael, do you have any other, background information you might want to discuss on this slide?
Yeah, one stat that we've talked about recently is the average length of a bull market is about 61 months, so a little over 5 years. So quite possibly we could be in the middle, just based on historical averages as well. And so that's something that I think is helpful to keep in mind.
Yeah, 2 years does not make a typical bull market. You are right. They tend to last longer, just like bear markets tend to be shorter in duration and a lot of times more severe. But we've had a nice run in the last couple of years, and we would anticipate a more subdued type of third year of this bull market. And that kind of leads a little bit to this chart, which also looks at stock prices after the Fed start cutting interest rates. And so this is an interesting chart, I think, because it goes back to 1974. And you can see basically what it's trying to look at here is when the Fed cuts interest rates, usually 6 and 12 months later, the S&P 500 is had positive returns. But not every single time, of course. But when we don't have positive returns, it's typically because maybe the Fed was acting too late and the recession trends had already started and they're playing catch up. But basically, again, it's this interruption by recessions that really are to blame for usually stock prices dropping as the Fed is cutting interest rates. And if we don't see a recession on the immediate horizon, then we're optimistic that this pattern can develop again in this year as well. So if you look at some of the data in here on the last 9 major rate hiking cycles, and when the initial cut starts, again, we get this 5.5%. That's what these numbers kind of work out to, rate of return on the S&P 500. If you take out those recessionary periods, and I know you're kind of just looking at overall data, but that number doubles. So you get a gain of about 10% in the markets, and that's again why we're looking at the S&P 500. We say, well, that's 5 to 7% potential returns, assuming again no recession. Then, and as we move forward a little bit, a lot of the stock market performance this past year, at least the first half of the year, came from what's called the Magnificent Seven stocks or 7 companies. And just for reference, those 7 are Alphabet or Google, Amazon, Apple, Meta or Facebook, as they used to be called, Microsoft, NVIDIA, the semiconductor stocks, and Tesla. And so those really drove some of the early returns in this market. And you can look at this chart and you can see why. It's because the orange bar is representing the earnings from those 7 companies. And over time, stocks follow earnings. And so if earnings are improving or accelerating, stock prices will go up because the stocks and the companies are more valuable as earnings are increasing. It's just simple formula. So we really saw that occur in the first half of last year. It started slowing down a little bit in the second half of the year, and we started seeing the stock market broaden out a little bit. Other areas of the market started to do well. And as you can look out in this forecasting part of this slide, what we're looking for is that the earnings from the Magnificent Seven will continue to be positive, just not at such an accelerated rate. And at the same time, I think the S&P 500 index, the other 493 stocks, earnings will start to increase. And so there'll be more of a balance there in that earnings picture is what we're kind of anticipating.
I think that's a really positive note, Mike, that we're getting some breath. I think we don't want those 7 companies always leading the economy. We want those, like you mentioned, the 497 other companies to grow their earnings and be part of the overall, tailwind that we're seeing in the stock market. So those blue bars that we see out in the second half of 2025, Q3, Q4, is catching up to the Magnificent Seven, and that's exactly what we want to see. Yeah, we don't want to see growth come down from those 7, but it's kind of that law of large numbers. If you do really well in one year, it's tough to be, double or, have that growth again from an Alphabet or an Apple or a Google or a NVIDIA. So I think that's what's happening. And as we get more clear direction coming out of tax, cuts for corporations, or, the consumer stays employed and keeps, spending money, some of those smaller companies, out of them will continue to do well. And that's what those blue bars are showing, the growth that we see in the second half of 2025.
Mm-hmm. Yeah, great point. And the other thing, when you look at this as an aggregate and all these S&P 500 companies, and the Magnificent Seven are still seeing very good growth rates, probably, somewhere like 17% is what that probably averages out to for this coming year. At least those are the predictions. We, as most of that are on the program, are our custodian, the brokerage firm that holds our clients' assets, is LPL. And LPL's put this together for us, and their research department out in San Diego, they're looking for the S&P 500 earnings. I want to get this number exactly right, to be $275, $75 for this coming year. So what we're looking for is price to earnings ratio on large cap stocks, the S&P 500 at about 22.5. If rates if they go up, if earnings go up a little bit more next year, you're going to be looking at a PE ratio of 21. You're like, okay, what's all that mean? What's the price to earnings ratio? It just kind of tells us how expensive, how cheap the market is. And we'll tell you one thing that we talk about at the investment committee meetings is this market expensive or not? And at 22.5 times this year's projected earnings, that's not cheap. It's not like these are all beaten up. And a lot of it is because of the expectations of these Magnificent Seven stocks and how they're priced right now. So we would argue that there might be, because of regulations maybe being lessened on a lot of companies, that would be a positive for banks, brokerage firm stocks. The infrastructure stocks should do well in this environment with all the spending that's going on in that area. And Michael brought up earlier that AI component, not only impacts infrastructure, electric infrastructures, and the build out of these huge data centers, but also impacts the spending in general. So I think we're going to see a lot of pretty good potential spend rates as a lot of these earnings from these companies tend to increase. If the economy would slow down, you could end up with, because of tariffs or higher borrowing costs, then if we don't see these earnings kind of increasing across, that will make it, that'll be a little bit of a struggle for the stock market, and that's why, again, we're optimistic, but with a little on the cautionary side. And Brian mentioned the corporate tax rates. We're going to keep an eye on that. That was one thing that was discussed quite a bit in the campaign coming up to this election, and haven't heard too much about it here in the last couple of weeks, but there was some talk about decreasing those rates for corporations. Yep. Okay. Another thing that we like to track, there's a couple of different studies that kind of look at consumer confidence and confidence in the stock market in particular. And there's times where people get very depressed about the stock market, and there's times where they get a little bit overzealous about the stock market. And we've got a little bit right now. If you look at the right side of this chart, what it's showing you is that we have a lot of exuberance as far as stock market returns. So when we did our poll, nobody on our poll came back and said, oh yeah, we're going to have this banner, great, fantastic year. So hopefully, just from working with us, you've seen that our optimism and being a little cautionary is kind of resonating here. But there's a lot of people very excited about stock market returns. And, we haven't seen U.S. households this confident, if you look at this chart, ever, that stocks are going to move higher in the year ahead. So, when you look at the risk taking that's been going on in the market here, it doesn't have to just be stocks, but it could be, look at the Bitcoin prices, that topped out at 100,000. Bitcoin's trading about 96,000. But at the beginning of the year at this time, Bitcoin was 43,000, so lots of speculation going on there, lots of exuberance going on there. And we're starting to see that, I think, move into the stock market returns as well. So would you guys want to address kind of what some strategies are that you might want to consider doing if we've got this time and exuberance and we want to be a little more cautious? Or do you want me to cover that?
I mean, I think the main thing there would be to talk with your advisor about your goals and your time frame and just confirm that the strategy is really geared around your specific situation. On the discipline side, we have our investment committee meeting every 2 weeks, and we're always reviewing this information for our clients. And then we meet with our clients regularly to, bring forward the best strategies that we possibly can to them on an individual level geared around their goals. And so I just really encourage to revisit that conversation, which we do in our regular meetings. But I think that really you want it disciplined around a strategy for you and customized, not just general strategy.
Yeah, I think the word I use is active management. Like Mike was mentioning, some sectors that we're watching and that weren't in our portfolios earlier. Some of the financial institutions. It could be more of the internet, the technology, but then we're also unwinding certain positions that we feel have kind of blossomed and kind of have fallen out of favor. So we are always looking for the next momentum sector for the next cycle in the economy, and that's driven a lot by this data that we've just been sharing with you in these slides.
Mm-hmm. Yeah, absolutely. And the other part of the discipline is not only are we meeting and going through this information, of course, but is rebalancing, and so there's just a time when the portfolio, certain areas of the portfolio has done better than other areas, take some profits off the table, so to speak. Let's take some of that money and allocate it towards areas that maybe haven't done as well. And that's a simple discipline to kind of look at the portfolios. Now, you don't do that every single day or every single month, but it is a scenario as money is maybe coming in and out of the accounts because people are adding to their accounts or they're taking money out for some of their expenses. It's a good time for us to do a quote unquote rebalancing of it. And that's a good discipline to get into. So if you have a portfolio that's supposed to be 80% stocks and 20% bonds, and because the markets have done really well, you're 85-15, that means you have the potential for some more volatility in the portfolio. Maybe that's the discipline to rebalance back to 80-20. So you guys brought up a couple of things on the investment committee meetings, some changes. We did add short duration high yield fund into the portfolio a little while ago. We'll talk about that when we get to interest rates. And you both have mentioned, some changes that we've made. Infrastructure is a big area that we do like. And we've talked here recently about removing some holdings that are focused on home builders and adding internet stocks because rates have actually been going up on the long term, the long part of the curve. We'll talk about that in a minute. So that's not the best environment for home builders, but just constantly monitoring it and trying to be disciplined in the portfolios is really what we get paid to do. And that's why we get together so often. So with that in mind, we're going to move to bonds. We're going to have a bond poll. And so the bond poll, again, will pop up on the screen. And, we're just kind of curious. Maybe I tipped my hand a little bit with this slide, but, what do you think about bonds? I think it's a great time to invest is one of the responses. It's okay, but I have some reservations. I'm neutral or I'm worried about bonds. And so we'll let some of the participants come in and see what is the outcome from the people watching. All right, so we've got some participants in. It's interesting. And I think it's a great time to invest in bonds. Is about 10% of the participants. Okay, and then we have it's okay. They have some reservations. It's a third of the participants on the poll. And then I'm neutral. I don't really know much about bonds. Those are really kind of two different areas. And then I'm worried about bonds and prefer other investments, which is about 10%. So the bulk of people say that it's okay or I'm neutral. That's about 77% of the poll participants. So we would kind of set up the stage for, we think it's actually a good time to be investing in the bonds. So we have interest rates on the 10-year bond has gone up. We call it here in LPL's research department calls it the golden age for income investors. And that's frankly just because rates have increased. Rates are still hanging around and have increased as 4, 5 to 6% level and are potentially higher. And if inflation is at 2%, or 2.5%, you've got a nice spread between inflation and what bonds are paying. And so this chart here is also interesting from the standpoint, it just shows the difference between the 10-year Treasury bond, which is about 4.8%, and the Fed funds rate. And the Fed fund rate, just remember, that's what banks loan to each other on an overnight basis too. So it's what the Federal Reserve has the easiest time controlling, because they can cut those rates, and therefore banks will charge other banks lower rates on overnight deposits. So Fed fund rate currently is in this range between 4.25% and 4.5%. And Brian at our investment committee spends a lot of time going through what's kind of anticipated for Fed fund rate cuts or increases. And so, Brian, do you want to share with the audience a little bit of the information that you usually cover in that investment committee meeting?
Yeah, then we can look at the futures of where we think the interest rates cut. In a month ago, the future market was expecting 4 interest rate cuts in the calendar year of 2025. And just in the short time frame of 30 days, that has gone from 4 to more likely 2. We think it might be somewhere in between that. But that's kind of interesting that, again, we're picking up some language from, Chairman Powell, who runs the Federal Reserve, and he's been pretty pragmatic about, hey, I don't need to maybe do as aggressive rate cut because we've been seeing good numbers on the unemployment side, and inflation is kind of creeping down. Again, we talked about that earlier. It's not coming down to exactly 2%, but it's at least directionally going in the right direction. So he's saying, hey, I don't need to touch, maybe I can pump the brakes a little bit, maybe like this rate cut, one rate cut, and then pause as we meet, the Federal Reserve meets over the year. They have 10 meetings a year. So I think that's kind of what's going on. So stay tuned. We would like to see, rates to stay, come down, but not too much, because then, like Mike was just saying, that ends up maybe pushing us into or predicting a recession, and we don't want that. So yeah, I think rates higher for longer is kind of the term that we've been using.
Mm-hmm.
So.
Yeah.
Now that might be frustrating for somebody that's trying to buy a house or refinance a house, because they bought a house and we'll just buy the house now and we'll refinance next year. Well, now this year they may not see that big decrease in mortgage rates as what we thought. So we might have to wait a little bit longer.
Mm-hmm. Yeah, that's absolutely what we have seen out there. And if you look at, I put this highlighter on here. If you look at kind of where rates are right now, this spread between Fed funds rate and the 10-year Treasury, usually there's a difference about 1.1%. We actually had negative for a while. What's that mean? It means short-term rates were higher than long-term rates. Okay, it's this inverted curve. And you can see in history, we've had that happen in the past. And a lot of times you'll hear people talk about it. And we brought this up last time, that this inverted curve leads to recession. Well, it doesn't all the time, so it's actually got some false positives to that analysis. But what we see here is over the last month, we're actually now, if we updated this slide, we're closer to the zero number. So we're at about 4.8%, maybe even right there if I was going to try to draw it in. We're at 4.8% on the 10-year Treasury. That was just 4.1% just a month ago. So that's a big jump up in the 10-year government bond rate. And at the same time, because late last year, the Fed was cutting interest rates. So now we have this maybe 3.5% Fed fund difference. So what you end up with is 4.8, and the Fed fund rate is, excuse me, 4.5. I said 3.5. But you see that we're right about even between those two rates right now, between 4.8 and 4.5 or 4.25 on the range. And so that tells us that there's maybe a little bit more room. Longer term rates could go up some more. We think that might be a little bit overdone at this point, or short-term rates could come down. And if we have a couple of rate cuts this coming year, like Brian mentioned, that seems like a more likely outcome. Short-term rates drop.
But in the meantime, we're collecting, a nice interest rate from the bond holdings that we have. So.
Yeah. So, if you look at, again, kind of the areas that we like in the bond part of the portfolio, that we've been investing in areas that that are a little bit unique. You may make us a little bit different. Convertible bonds had a very good year last year. And those are correlated to the stock market. So they've got some correlation effect there. And we had such, there's some good returns in that area last year. Shorter duration, as rates are going down on the short end of the curve, seems to make some sense. As a matter of fact, we decreased our exposure to intermediate bonds a few months ago and moved it to shorter term high yield bonds, and so and there's some good opportunities there when you talk about coupon. The coupon rate is around 8% in that area. But you also have a little bit different risk level because they're high yield corporate bonds.
Yeah. But if the economy stays strong and these corporations can still meet their debt service levels, then those short-term high yield shouldn't have much change in price. So, but yeah, we go into a recession that could change quickly.
Yep, absolutely. And most of our people watching are Minnesota residents, and so we also like, outside of the IRA accounts, we like tax-free municipal bonds, and you still get a nice rate of return on those, and the tax savings are obviously pretty significant versus a taxable bond.
Yep.
So, all right. The one thing that's also interesting about interest rates is how are they affected just by this, by bonds coming due. And this chart is something that I think everybody will find interesting. It talks about kind of what treasuries have to be replaced because they're maturing. And what you see is this huge spike up in 2025 of about $6 trillion of bonds that need to be replaced this year. I guess that's the right word, replaced by new bonds that the federal government will be issuing. And don't forget, since we are running deficits, there's more bonds that need to be issued to keep the economy up and going. So that's another $2 trillion. So this 2025 time period could be pretty crucial for interest rates, and it depends on how well these bonds are received by the global markets, because most of our bonds are bought from foreign entities. So Brian,
there can be a large supply hitting the market, and we have to have investors buying this. And again, like Mike said, it could be, other countries, it could be, insurance companies, pension companies, they all are buyers of our treasuries. But the Federal Reserve and the federal government treasury has to, put them out there, and there's got to be somebody showing up at these auctions and buying these. And if they don't get enough buyers, then could potentially keep interest rates higher to attract even more investors to come in to buy these, new issued treasuries, because if they're look attractive if the rates are high. So, but if the rates come down and they're, kind of lukewarm reception, then we won't be able to sell these bonds. And that's obviously pragmatic to the economy, because we need to keep the government going as we keep running a deficit. And like I said, we have to refinance $6 trillion of bonds that are already on the books.
Yeah, so it's a big undertaking for this year. Now, I don't want to be alarmist and be like, oh, that's going to create a financial crisis and a collapse of the U.S. economy. We don't see that happening. It's just a matter of what interest rate is going to be needed to generate enough demand for the bonds. And we maybe are even seeing this a little bit in interest rates now. If you look at 10-year treasuries, and ours at 4.8, and some of the other treasuries at 10-year duration, and Germany, for example, are 2.6, Italy's 3.8%. So we already have a little bit higher interest rates, even though we have the best credit quality in the world, and it's considered a risk-free investment. So, we are currently paying a little bit more in interest rates on these bonds now, and we're just saying that this could be something that this is something we're going to be watching closely, but it could be something that would impact interest rates if we have to get out there and to attract more buyers.
Yeah. Having lower rates in other countries actually makes our bonds and our treasuries look more attractive. So, foreign investors can come to the United States and, replace their lower interest rates in their home country to, treasuries that are at higher rates here in the United States.
Yeah. Really, when you look at all the markets, the only place that's about the same as us is the UK. And so, then, the other uncertainty that comes into this is kind of with, with the Republican sweep of Congress and the White House. We don't think that the deficit's going to, change drastically. As a matter of fact, it could be the opposite. If some of the policies around cutting corporate tax rates a little bit more, that could drive, at least short term, more deficit type of scenarios. And then tariffs as well could have something to do with that too. So we have a few things that we're watching out there in this area.
Absolutely.
So let's move on from that area and have another poll, which is going to pop up here, and it's which investment strategy do you find most appealing for 2025? And that poll is going to have a few different areas: diversifying with alternative investments like private credit, focusing on stocks and equities for growth, investing in bonds for income, and staying cautious and saving cash for future opportunities. Are kind of some of the poll respondents that you can pick from. We'll have a few people answer what they think might be a good strategy, and then we'll kind of get into what our thoughts are. All right, so I'll just jump into it. The numbers will change slightly, I'm sure, as I'm talking, but over half of the participants are focused on stocks and equities for growth. And we would agree that makes the most sense, especially over long time periods. Our investors tend to be with us for years. Our clients tend to be with us for years, I should say. And investing is a long-term proposition to make sure that we're not trying to quote unquote time the market. But if you focus on stocks and you focus on good quality companies, over time, that generates, typically, as in the past, probably will in the future, but there's no guarantees it will, better returns than other investments. It's interesting what I see here is a third of people are talking about investing in bonds for income security, and so that interest rate, that coupon that Brian was talking about earlier, which is our old terminology that we used to use way back in the day, actually before I was even in the business, where you literally cut coupons off of the certificate that you'd get from a company, and you'd go to the bank and get your interest payments. So that's where that term comes from. So I'm going to go into a couple of things that aren't necessarily tied directly to investment strategies, but the geopolitical scene and kind of the international chessboard, we're not going to spend a lot of time on here by design. But what's interesting is we've had a lot of geopolitical threats over the last couple of years, and the stock market continues to kind of move forward. And it's possible some of these threats could actually be negotiated or mitigated, here in the relatively near future. Israel and Hamas are talking about some sort of discussions. Russia and Ukraine seems like it's more likely the current administration would like to try to settle something there. In these negotiations, nobody is ever 100% happy with them. But what we're seeing is, when you look at this, we had, going back to this 5 years, we had COVID. Remember 5 years ago, we never even heard of COVID, literally at this time. It's just maybe starting to pop up as this thing going on over in Asia. And so we had a big drop in the market and a big rebound in the market, that big V. And then we had 4 years ago, 2020 election uncertainty and everything that was going on there. And look at the markets over to the right just kept on marching. And then we had the Russian invasion of Ukraine, a temporary drop in the market because of oil prices bouncing up to about $130 a barrel. But then the markets, started to trend. Took a little bit longer because we had to get through the 2022 bear market and the increasing interest rates that came on through the supply chain issues. But you can see we kind of just started making our way back up towards, and then about a year ago, we had the conflict and war in Israel, and the markets have continued to go up. And you have a Trump assassination attempts, China encircling Taiwan, and some tension going on there. So it's interesting as the markets have navigated successfully through a lot of these high risk scenarios over the last couple of years, but they tend to do it just over the course of history. So, there's a chart one of the mutual fund companies put out, and it goes back for decades, and it looks at the different historical events that occurred on a geopolitical platform. And while they might have created some shorter term volatility, they usually aren't affecting the long-term performance of the US stock market. Do you have anything, Brian, you were going to maybe add to that?
No, I think, sometimes we shake off, sometimes bad news will rattle the market, but it's usually, like you said, on a shorter term basis, like this graph shows over time. 5 years is not a long time, but, it goes from, lower left to the upper right, and that's what we want to see.
Yep. Yep. And that's, and this again is the US stock market is measured by the S&P 500. There's other areas of the market that's, smaller companies, mid-sized companies, and international. There's a scenario, maybe this is a good time to talk about it. We've been very, very underweight international for a number of years now, as far as exposure to that area in our stock part of our investment strategies. And we talk about it almost every investment committee meeting. And we still think that the best growth rates are going to come out of the US. And while we have a small amount of money in international, it tends to be high quality dividend paying stocks on the international basis and less geared towards emerging markets, for example. So, that comes into play a little bit on the commodities front, and so specifically, China has really been driving commodity prices over the last decade or two, because the Chinese have grown their economy by building. I mean, they're spending a lot of money. Their deficits are way up. They've created entire cities and transportation networks that people don't live in. And so when they're building all these buildings, these roads, these tunnels, you're using cement as an example. You're building out the electric infrastructure, but really from a commodity standpoint, it has had an impact on commodity prices. And that's kind of what this orange line is showing. And then the blue line just kind of shows that it's stalling out. These are two different time periods. That's why it's a little confusing. But you can see commodity prices are not anticipated, at least on our end, to be something that's going to really continue to be increasing. And the biggest reason is because these huge developments and double-digit spending rates that the Chinese have done have really are overbuilt, and they're not going to be continuing. So less demand for commodities is really all it comes down to, And China's got a couple other issues, regarding policy issues that they have, and they also have a declining population because of their growth rates with their previous policies of kind of restricting families from having children. So that's coming back to get to them too. So another reason why we really just don't like the international stocks, and that could change, but as of right now, we're holding steady on the severe underweighting in that area.
Yeah, I think corporations are looking to onshore, coming back to the United States. So again, pulling dollars out of international and bringing back to the United States. If you're a manufacturer, if you're a supply chain, kind of that first, America first kind of concept. And I think that's going to continue here for the next 4 years at least.
Yeah, absolutely. That's core part of the new administration policy. And so it'll make it even more difficult for the international area.
And our dollar's getting stronger too, which we haven't talked about, but that's another thing that we've been watching. So.
Yep, and that's also bodes unfavorably for international stocks.
Exactly.
Yep. So I know from the standpoint, we have some questions that have come up in the chat window. Michael, are you managing that for us, or should I jump into it?
Yeah, I've got a question here. Would you expect wood to be more expensive with all the houses that need to be replaced?
With the fires out in Los Angeles, I guess, is that specifically? It's interesting. We have seen timber prices increasing on that commodity side a little bit here recently, and there's an ETF that follows kind of the timber industry that we track. We don't own it in the portfolios, and it's not even we're actually near the top of our strength metrics where we would be buying it, but it's possible, that it's just a matter of the other side of that is how much supply is out there. So if there's a lot of timber available, that might just be absorbed by the increased demand. Also keep in mind a lot of this just horrific fire disaster areas are close to the water too, and so a lot of those homes don't get rebuilt with timber, but they get rebuilt with block, like cement block and that sort of thing. So it'll be interesting to see how that develops, but we haven't worked that into our equation yet because it just literally started last week.
But yeah, in the short term, that ETF hasn't really jumped up, so it doesn't seem like the investors are seeing opportunity to buy into that ETF to take advantage of maybe this short supply. So that's interesting. So there might be enough supply out there to rebuild and take care of that. And the softening on the other side of the rest of the housing market is getting softer, as we know too. So yeah.
Yeah, and so what you end up with is maybe it's just a balancing out effect, And obviously we had hurricanes, especially last year, kind of come through certain areas of Florida, especially the Fort Myers area, and devastated in the last couple of years some of those areas. And we haven't seen a huge increase in timber prices based on that rebuilding either, So.
Another question came in. Do you see any bubbles affecting the markets? Crypto as a question mark after.
Yeah, that's a good question. You guys can all jump in there. We do talk about crypto. We don't own it in our portfolios. It's very speculative. If you look at specifically just like Bitcoin, it's 96,000 a share. It was 43,000 a coin. There's no such thing as a coin. You don't get coins per se. It's this digital aspect, and our concern with the volatility of that is it just seems like it's become very, very risk oriented, and a lot of people are buying Bitcoin, hoping that the next person will pay a higher price than the price they paid for it. That looks bubble-ish, to me. I know that's not a word. I just made it up, but those are the sort of things that are concerning. We'll see how this plays out. But I've been doing this now for a while. We set up the firm back in 1995. So we're celebrating our 30th anniversary this year. And I remember in 1999, the euphoria around .com stocks. And it was because of the internet was going to replace everything. And these .com companies were going gangbusters. And so you had all kinds of companies with very bad business models. If they even had a business model, probably generating no revenue really to speak of, but trading at $100 a share. And most of that exuberance washed itself away in 2001 and 2002 when those markets cooled. I don't know if Bitcoin's going to do the same thing. We're going to see that sort of bubble in there. But I do know that there's some similarities. Bitcoin doesn't have any value except for the value that somebody else is going to pay for it. And that's concerning when that goes up, a double or more like it did this past year. You guys have some input from the investment committee or thoughts around this?
Yeah, outside of crypto, I think, we mentioned some of these Magnificent Seven companies have stretched, their pricing of their stock compared to their earnings. And, NVIDIA comes to mind. So if they cannot continue to sell chips at a high rate, maybe that stock is overpriced compared to, what the future holds for NVIDIA. So those are always small bubbles that could be in certain companies or maybe certain sectors. But like we said, there's also sectors that are undervalued, that could benefit from a tailwind that's coming out of Washington with lower regulations and things like that. So,
Yeah. Lower regulations could be a big thing going forward for a lot of companies. You look at the banks and the brokerage firms, some of the healthcare companies as well, potentially. Those are all areas that frankly didn't perform that well last year. And so infrastructure is another area. Not only do you get, a lot of spending going on in that area, but both from the government, because remember when Biden came into office, there was a $1.3 trillion spending bill that was really geared towards infrastructure. And now infrastructure build out also focuses around this need for computing power to be exponentially increased because of the AI demands that are out there. So there's a AI and NVIDIA and those sort of things. There's a different while they've seen some increases, and you're absolutely right, Brian, the difference between like a company like a Nvidia or some of these .coms that I'm talking about is those earnings, that have been coming out of Nvidia. And so to your point, it's a great one though, is can you expect that going forward?
Yeah.
Probably not at the same rate. Seems logical. You couldn't expect that same rate.
Yeah.
Any other questions that have popped up? I'm going through some of our disclosure information that we have to show everybody. Basically talks about investments go up and down. And so there's no guarantees that the investments will go up. And really what we like to do is just make sure that our clients have a diversified portfolio that meets their specific needs. But this disclosure information goes into what we all know as investors, that the markets go up and they go down. And that's the premise of a lot of this disclosure information. Michael, any other questions maybe that have popped up either on your end or from the chat?
I don't see any in the chat.
Okay. All right. Well, if you do have some questions, reach out to your financial advisor. We'd be happy to go through it with you. There's some people on this program that are brand new to 360 Financial. We encourage you to stick around for a few minutes. We're just going to talk a little bit about our process, kind of how we work as a firm with our clients. And like I said, we've celebrated our 30th anniversary this year. Lots of our clients have been with us for a decade or longer than some. Maybe on this presentation have been with us the entire 30 years. So we've got a process. We think it works very well. It's proven over the years to provide a roadmap to people looking for the ability to focus on their family and their other goals, and to also focus on kind of what we can control. If there aren't any other questions that have popped up for the people who want to stick around, I will do a little bit. Of background information on the firm. So here's a group picture. So we have now 23 people that are part of the firm, either directly or indirectly through our association with the CPA firm or Packy & Company over in Edina.
Mike, I'm not seeing the screen share at the moment.
Oh, you know what? I didn't turn it back on. That's why. Okay. Thank you for cutting me off. Let me get back to that. Now I'm going to do, so you guys just get to see me right now, fumbling around with the computer, right? So let's see here. Sorry about this delay, but we'll get you into this right now. Come on. There we go. Now you can see our happy faces. So this is just a team picture that we took here recently when it was not 0 degrees outside, but we took it this fall. And you can see here we have our Elk River office is represented with Brian and Danielle and Carrie up there. The CPA office over in Edina is represented with Joe right in the middle next to me. Anna is on here and Brian is on here from the CPA office. As Rita is not in this picture. And then we have the office in Wayzata and our team members here. So everybody that we work with gets dedicated support from this entire group of people. And out of this entire group of people, we've got a robust investment committee that meets every other week, goes through our investments. We have well over 200 years of investment experience on this committee. And that's when we spend time really diving into what's going on in the markets. Where do we think we can make some money for our clients? What areas do we want to avoid? We gather up this information. We take action steps out of it if we need to. And that's where we do come to conclusions like, let's go to short-term high our high interest paying investments and decrease the intermediate term bonds, where we make changes like from semiconductors to other areas of the market and have those discussions. So we're not making changes every other week to our portfolios, but we do discuss them in detail every other week and then take action steps out of it. And when you're looking at kind of the way that we work with our clients, not only do we have the investment committee, but really what's important to our clients are the form goals. And we talk about form goals at all of our meetings with our clients. We also talk about them at our weekly team meetings. We want to update everybody on what's new in our clients' lives. And so what we focus on in form is your family goals, your occupation goals, your recreation goals. A lot of times occupation could be as simple as, what date does work become my choice, or a work optional type of date? And then once we're beyond that, what do you do to drive some purpose, to make it feel good that you're providing value and use your expertise and knowledge, and maybe in other ways that are different while you were working. Okay. The recreation goals, again, are those areas of life that bring the juice to kind of living. Those are the things that are your quote unquote bucket list goals, but they don't even have to be that. They can be as simple as spending more time fishing. Okay, doesn't have to be a fishing expedition, but just more time. And how do I manage that? Typically, travel is a big area for our clients, and we use that recreation goal setting around that travel budget to make sure that people feel comfortable spending money on travel, and they don't delay those experiences because they feel like they can't afford them or shouldn't spend the money. So these form goals, family, occupation, recreation, really focus, and then around the why of what it is that you're trying to accomplish to be successful in these areas. And then the money goal really typically tends to be the conduit, like it says. It's the driver of those other goals. If you will, it's the gas for the engine. And the engine are the family goals, the occupation goals, and the recreation goals. So in our life wealth process, what we focus on, and we call these our life wealth plans, is this overlapping of what matters to you. Again, these form goals around family, occupation, recreation, and money, and the why, and how the money can drive those options to address those. And then we also need to focus on what can we control. The reason we do these programs, and we do a number of educational webinar programs, is so that we can talk a little bit about what we are trying to control. We know there's certain things we can't control. We've learned that from experience. We didn't know who's going to win the election, but what we can control is looking at policies that might change and tax rates that might change, and how would that impact our portfolios. We can't control what Congress passes, but once things are passed, we obviously can control how we manage that new environment within our investment strategies and around the form goals. So we just need to focus on the aspects of what we can control, which we break down into 3 P's: our philosophy around our plan and our process, and how do we work with our clients through this discover, design, and deploy structure, where we discover what your goals are, we design a customized plan around those goals, and then we deploy or implement the strategy, and we constantly monitor that. And that's the life wealth plan process. And it sits right here in the intersection between what we can control and what matters to you, to hopefully drive the outcomes to give you a successful goal setting and achievement scenario. And through this life wealth process, the way it works is we have kind of a 4-step cadence to it. And we meet with potential clients in what we call our fit meeting. And that's just a conversation. Do the services that we offer make sense for you? Okay. And what you need, does it align with what we do? Is there a good fit between our organization and your needs? So if you came into our office, for example, and you said, "Hey, Mike, let's just buy Bitcoin and and you were talking to me or any of our advisor, and that's what you want to do, highly speculative investments that will be highly volatile, that really aren't areas that we consider to be in our wheelhouse, that wouldn't be a good fit. And so it's important for a long-term success that we're starting out on the same page. And if we are, then we move to this what's called the get organized stage or meeting. And that's literally where we're gathering up a lot of information. We're gathering your investment statements. We're gathering your tax returns. Part of what we do here in the implementation and the set motion is review your tax returns, pull together a 2-page summary of everything that's in that. And this is the benefit of having the CPA firm with us as well, with Joe and his team over in Edina. We can analyze those tax returns and start looking at what tax strategies might make the most sense going forward. Once we get through that get organized phase, then we set into motion an implementation process. When do we start working with you on certain aspects and then of your plan? And then we constantly review and realign that plan. And so the cadence might look like something like this. Once the plan is implemented, we can get the plan implemented as quickly as usually about a month and a half, but it's that monitoring aspect of it. And if you look at wealth management in 4 different pillars, there's investment management, there's estate planning, there's tax management, and there's risk management. We break down into quarterly conversation and quarterly topics with our clients, what those, go back to that, conversation might be for that specific quarter. So the point that I'm trying to get here to you, if you're new to 360, is we have a proven process that's worked very, very well for us, very disciplined, and it's investment related, but it's also covering areas that are most important to you and your family. And that usually leads us to estate planning, usually leads us to risk management, usually leads us to tax planning and strategies, and how do we implement that within a life wealth plan. So you guys on the call, I'm doing all the talking. Anything maybe that I missed?
I would just say that if that sounds like a valuable process, feel more than welcome to schedule 15 minutes with us, and we can talk more about how we could use this process to your benefit.
Exactly.
And for the current clients that are on the call, we also offer what we call a sounding board process for anybody that's important in your life. They're important to our life. So have them come in and talk to us about anything. May not lead to a good conversation, and maybe help them, short term or long term, but use our sounding board process too.
Yeah, thanks for bringing up the sounding board. That's such a unique and special offering that we make to our clients. We're literally, somebody's important to you, like you were saying, Brian. It could be family, it could be a friend. They just have some questions. They have some uncertainty. They don't know where to go. Call us, and we'll give them direction. If they need our services, they're a fit. That's great. But if they don't, that's fine too. We just want to help, and that's part of what you get as a member of 360 is that sounding board. So I'm glad you brought that up. Okay, with that, I think we've completed our program for today. So thank you everybody for joining us. Thank you panelists for joining. Thank you Troni and Cameron for organizing this webinar. And we look forward to talking to all of you in 2025 and helping you live your most impactful life. And if we're part of that, that's pretty special to us. So thank you.
Thank you.